Today, we're going to introduce you to the accident sickness riders. You'll recall in previous sessions that we talked about riders, and we said that one of the key elements of riders is twofold. It's essentially to customize the product to your particular needs, but also to customize it to your particular budget as well. So riders basically enhance the basic coverage. So for example, if you bought $3,000 a month of disability insurance, and you wanted to enhance that for various different reasons and everything, riders are very, very useful when it comes to actually doing that kind of that kind of work, in that it customizes everything specific to your needs. Okay, now there are a number of different riders, so we will be stopping along the way to give you a more insight into the various different kinds of riders. The first one, and probably one of the most popular ones that we have, is what we refer to as future purchase option. And FPO, as it's commonly known as FPO, but sometimes you might see in some certain publications or companies where they call it FIO, which is a future income option. And some companies go one step further, is they call it a GIO, guaranteed income option. The idea of future purchase option is basically that you will be able to buy more disability insurance in the future. So for example, if you've just graduated out of university, you're 25, you're 30, whatever it is, your income is relatively low right now. As you know, we have the 60% rule. In other words, you really should not be making any more on disability than 60% of your gross income. So in an effort to stay within that 60% rule, they might say, okay, you only qualified because you've just graduated, you have a low income and everything. You only qualify, let's say, for $1,500. Well, that's fine, except that as you grow in your business, as your profession grows and everything, obviously your income will grow as well. And if you're healthy, the insurance company will be more than happy to sell you more disability insurance. That's not an issue. The problem comes down to is, what if you're not healthy? What if at some point in the future you have a major medical issue, an accident, whatever it is, which renders you uninsurable? So the question of the future purchase option really is, how do you ensure your insurability? How is it that you can buy more in the future without having to worry about what if I become disabled or whatever? Well, what you would do is you will buy a future purchase option. Now, some companies will have a certain number. So, for example, you could buy $1,000 more every single month, let's say, disability. Some of them will say a percentage. Different companies will treat these things differently. But basically what we're saying is that with the future purchase option, you will have a number of options from the date that you actually apply for the original insurance policy all the way up to age 50, 55, when this sort of rider falls off. You'll have a number of options to be able to buy more disability insurance, again, without medical evidence. All you have to do really is pay the attained age rate for that. And so the insurance company, regardless of your health, cannot turn you down. So for example, let's say you do have that $1,500 and now the option can come up. You need $1,000, and you have an option to buy another $1,000. As long as you apply for it, basically at that particular time that you're allowed to apply for it, regardless of your health and everything, they have to give you that $1,000 because regardless of your health. If you apply, for example, for $2,000 and the company is saying no, you're uninsurable, they cannot turn you down for the $1,000. They still have to give you that $1,000. But they'll decline the extra $1,000, so to speak. And so therefore, the future purchase option really, really gives you an opportunity to really enhance your coverage as you need it, as we go along. Okay. But always remember that regardless of all that, you still have to lie within that 60%. So you can't be overinsured. So at 60, some companies might allow 65, but generally speaking, the 60% rule is what companies will work with, basically. Okay. The next one, which is again extremely popular, is what they call cost of living adjustment, or commonly known as COLA. Okay, COLA. So cost of living adjustment is really for the individual who says, that's great, I've got $3,000 a month, and it buys today $3,000 worth of goods, let's say, but what happens in the future when inflation, as you know, inflation erodes the purchasing power. So 5 years from now, 10 years from now, $3,000 only buys, let's say, $1,500 worth of goods. How do I make sure that my $3,000 will always buy $3,000 worth of goods? In other words, maintaining my purchasing power. Well, you can have a cost of living adjustment. And there are a number of different kinds of cost of living adjustments. So, for example, you could buy that goes according to CPI, Consumer Price Index. It's 2%, 3%. It all again depends on the company that you're buying the product from. But essentially, it comes down to two main kinds. We have what's called a simple interest, which is basically, let's say it's 2% off $3,000, so that's $600. So it's always 3% off $3,000. It's always $600, always. And the other one, of course, is compound. This, of course, will be more expensive because that compounds year by year by year. So as a result, you can see that it can really add up fairly quickly. So in both cases, the companies will once again cap it at a certain amount. So, for example, 2 times the base. So you started with 3,000. The maximum you can compound to is 6,000, let's say. So companies will have those kind of limits, always to make sure that you sort of remain within the 60, 65% threshold and everything. The next one is AD&D, accidental death and dismemberment. And some of you may be familiar with that particular one, because this is the one where we're basically saying is, should you die of an accident, you will get a lump sum. Okay, so let's say you insure yourself for $500,000 worth of AD&D. You died of an accident, then you will get $500,000. But you'll draw your attention to the word D, which is the dismemberment portion of it, okay, which basically means that you have that accident, but you did not die. However, you lost a part of your body, so to speak. So the general rule of thumb is if you do lose 2 of anything, you get 100% of the coverage, 500,000 in an example. You lose 1 of anything, it will be 250. You lose, so in other words, there's a table. So companies will provide you with a table and say, okay, depending on the particular loss that you may have, this is what we're going to pay you out of that 500,000. This is what we're going to pay you. So you have to take a look at the table that the companies have essentially, and you'll see exactly what you're going to get covered for. However, I draw your attention to a very important number, 365. And therefore, that means that from the date of the accident, you have to succumb to your injury. Either you died or you were dismembered within that 365 days. Okay, after 365, you'll be considered natural death, or in other words, you get disqualified. So this incident has to happen within 365 days. So we'll stop for now, and we will continue in a moment.